Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little bit of money. My job is not just to entertain, but to teach. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. If people were expecting the Federal Reserve to give us fireworks, they were sorely disappointed. Fed Chief Jay Powell is not giving it hyperbole. He's trying to balance price stability with job growth. And right now, the risks tilt against the latter. As Powell told us today, the labor market is really cooling off. So the widely expected quarter-point rate cut made a ton of sense. But the market was all over the place after we got this widely telegraphed news. Dow gaining 260 points, S&P dipping 0.1%, NASDAQ declining 0.33%. It made you feel like the Fed somehow took us by surprise, but that was not the case. The market's reaction tells me two things. One, there are people who actually believe we get something bigger. And two, there are people who think that stocks are overvalued without big rate cuts. Given that Powell said, quote, there wasn't widespread support for a 50 basis point cut today, end quote, we were going to see some sellers. Perhaps there were enough investors out there who thought the Fed would give in to the president and bless us with a 50 basis point cut. Those people are delusional. While we could have gotten more dovish language from Powell, of course, a tad disappointing to equity investors, no big themes were upended, no longer-term gains were put on hold. In the end, everybody with half a brain knew we'd get a quarter-point cut, so it shouldn't have done nothing to the market. If anything, the market's wild action after the 2 p.m. statement and the 2:30 press conference created some interesting buying opportunities. Why is that? Because we around here do not trade cuts in rates. That's not what we do. We don't buy or sell stocks based on statements by Jay Powell. We're not that thoughtless. Of course, we want to see how the bond market reacts, and bonds were all over the map, finishing down in price and up in yield, unfortunately. But it was nothing major, almost kind of back to our regular programming. Almost, because the president's going to hammer Powell for doing so little so late when he gets a break from some state dinner. So what's changed here? Honestly, not much. Just that people don't like to say that, because that's not newsworthy. First, I think we can stick with technology and with artificial intelligence, the failings of companies that are involved in both. We had something very strange today, a story about how the Chinese government wants a full stop in buying Nvidia's artificial intelligence chips for some of the biggest clients. Those are the ones that are made for China. We thought they'd be welcome there. Very confusing, very fluid story. Now, I have to tell you that the Chinese narrative has become the defining story with Nvidia, and I think that that is dead wrong. There's lots of positions in play here. You could argue that this is a ploy, something that can change on a dime when the president talks with President Xi about the People's Republic. After all, the Treasury won't get its 15% of China AI chip sales if nothing sold. 15% of nothing? Suboptimal. You could argue that Nvidia looks like it'll be shut out of the market that's worth about $50 billion in sales per year. Right now, Nvidia has no China numbers. They're not in the numbers. So don't expect number cuts. That's why I don't think there was a reason to sell here. Me, well, shocker, I say own Nvidia, don't trade it. And if you can get some in at the 160 level, oh boy, I'd be a buyer. Nvidia's at the heart of AI. The new chips that are coming out are way ahead of the current ones. The Chinese government needs to be mindful not to shoot itself in the foot. Other countries will get these chips, which will take AI to levels where it can truly surpass humans in many different kinds of problem solving and surpass all those Chinese companies, too. Nvidia now has the worst case scenario in China. Everyone knows that. I think that's your best chance to buy. Second, as I mentioned yesterday, the banks are still looking good as short rates go down. They borrow at the short end of the yield curve, and then which fell, by the way, because of the rate cut, and then they lend long, which is higher. So when long rates drop and long rates rise, the banks, and when short rates drop and long rates rise, well, I got to tell you, that's when you buy the bank stocks. At tomorrow's noon CNBC Investing Club meeting, I'm going to talk about this. I'm going to tell club members that I intend to stick with the banks, even though we have huge profits. If you don't own any, then still you can buy Wells Fargo, which is stalled here in the $82 range, and you can get even more buying of Capital One if you own some of that, the credit card bank, which will make a fortune now that it's merged with Discover. Very few defaults at Capital One, far fewer than I thought there would be at this point in the cycle. As Jay Powell said, households are in good shape, and that's not about to change. Third, the market turned on the travel and leisure stocks again. Oh, God, they keep doing that. Even as I continue to tell you that COVID changed the industry permanently. Marriott was crushed today, which makes no sense at all, especially when American Express was up 3% to hit an all-time high. Fourth, I don't see any real reason to get excited about the interest rate-sensitive cyclicals, including the housing stocks. Those are the stocks you'd buy if we heard that the Fed had a very serious debate about whether to have a double rate cut. We didn't get that. Now, for instance, we own Home Depot for the Travel Trust. It's been a big winner, and I'm not surprised that it got dinged today down 1%. You need to hear something about bigger cuts to get that stock higher, and it didn't happen. It's going to be slower. It's still going to go higher, though. I don't feel great about the cyclicals in general, even though Caterpillar hit an all-time high today, unless they have something to do with the data center or with aerospace. I'm concerned, for example, about FedEx, which reports tomorrow. 25 basis point cut won't change things in time for this great shipping company. I'm even more concerned about United Parcel with its 7.8% yield. That yield's too high, may not be sustainable, even as management keeps saying otherwise. Fairly or unfairly, when you see that kind of high yield, the stock market is saying, don't trust the dividend. Now, there are plenty of critics who will find something that Powell said and try to make it sound controversial. Ginning up stories is what I call it. There'll be some vicious riposte against this man when the president hears what he's done. But the simple fact is that the Fed's caught between a rock and a hard place. We really haven't gotten inflation under control. At the same time, the job market is deteriorating rapidly. At the moment, the Fed thinks the job situation is more worrisome. Besides, the Fed can't beat this new inflation because, well, a lot of it comes from tariffs. Remember, our president wants to ignore that his tariffs are causing the inflation. Powell can't do that. So don't ask Powell to cut rates 5 times. Powell has a reputation for being a prudent person. And that is something that all Fed chiefs want to be known for. We have Powell until May of next year. He'll cut rates further if jobs stumble or inflation comes down or both. But he doesn't want to get ahead of himself because nobody, and I mean nobody, knows what the real impact of tariffs will be, except it's going to be negative. The bottom line, sorry, spectators who wanted something exciting. It's steady as she goes from Powell. And it's, well, if you ask me, exactly what we needed. Spencer, Michigan. Spencer.
Hi, Mr. Cramer. Thank you for taking my call.
Thank you for calling, Spence. What's up?
My question is on Micron. They raised their guidance in August and are heading into earnings next week with stronger revenue and margin expectation. The stock's been on a tear recently. Is it still a buy before earnings?
Okay, here's the problem. Sanjay Mehrotra, is the CEO, is fabulous. He's fabulous. That's one of the reasons why the stock went up so much. But he's also prudent and he's conservative. He may not say the words that Wall Street wants after this big run. I think you wait and see at this point. And remember, again, I have said to you that I like Sanjay Mehrotra, but a stock up 80% year to date, I think that he will be prudent. Dustin in Oklahoma. Dustin.
Booyah, Jimbo. Dustin from Oklahoma. My buddies call me Wit. It's good to talk to you again. I hope you're feeling better. Looking forward to the meeting tomorrow.
Well, I appreciate that. I can't wait for the meeting. What's happening?
My friend, so I got into this stock about 4 weeks ago at $585 cost basis. With the current administration's view on wind and also considering all the countries pouring so much capital into America right now, what is your long-term view on GE Vernova still?
Okay, I don't want you to worry about wind. They've got a lot of, there's a lot of things involved with wind, including maintenance, that makes it so I'm not that worried. And it's a very inexpensive way to power. You don't necessarily need the government. I know it's a negative. The stock got hit very badly when the president came out against wind. But I come back and I say, wait a second. This is natural gas. It's a natural gas story. And every time it is down, I say, buy. So that's what the plan is, okay? Let's go to Naveed in New Jersey. Naveed.
Hey, Jim. How are you doing?
I'm doing well. How about you?
I'm great. Just celebrating my wife's birthday today, so I'm very happy.
Hey, happy birthday to her. That's fantastic.
Thanks. Hey, Jim, I wanted to pick your brain on Salesforce. I've been watching this stock. I got into a very large position yesterday. The stock's year-to-date's been beat up. What are your thoughts?
At 21 times next year's earnings, I am beginning to think that I'm not going to pull the trigger on more because the trust has a very small position. I'm beginning to think that the buy case is just much better than the sell case, down 27%. They've got a terrific business. They're everywhere. I think Salesforce is okay to buy if you don't own any. I'll pound the table if it goes even lower. A Fed under Jay Powell is steady as she goes. That's just the way it is and exactly what we need. On Mad Money tonight, shares of Workday pop today on news that Elliott Management is taking a stake in the company. I'm getting all the updates with the CEO. It's a real good story. Then should the Polo Bear rebrand himself to the Polo Bull? I'm taking a look at Ralph Lauren and telling you where I come down the stock. And after a Fed rate cut, it's always good to check in on an economy and the stocks that are driven by it. That's like Ferguson. I'm sitting down with the CEO to get the latest. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.